joins us now from the German Institute for Economic Research. What's your opinion? Have the Greeks actually been saved from tragedy?
I think the summit got quite stuck in the middle. They bought some time with their conclusions. But seen on the whole, we have expected much more in terms of the haircut, the reduction of Greece's debt. This especially means that Greece has not been alleviated with respect to the total debt burden. What we expect is another haircut necessary to be in around 2013.
Mm-hmm. Let's have a look at the two rescue packages to date. Last year, the European Union footed the bulk of the bill, 80 billion euros. Another 30 billion came from the International Monetary Fund to make up 110 billion in all. In the new bailout, more than a third comes from private investors like commercial banks and insurers. Now, we're talking about the same amount of money, but what sort of a difference will this make coming from private creditors?
In principle, this should serve for a fair sharing of the debt burden, because all the investors from the finance industry should have known that debt beyond 60 percentage points of GDP is not reasonable and not sustainable. This is a kind of punishment, but if you look closer to the results, there is no punishment for the banks at all, because everything is guaranteed. They earn very much by the technical enacturing of the debt restructuring. They earn very much from the interest rate spreads, so the haircut is too small. And there's a zero additional burden. And you do not have hedge funds in, by the way.
OK, last time you were here, you said new packages, new rescue deals wouldn't settle the markets. Is that still the case?
I think the markets still realize that some time has borrowed, so the markets are quite calm. But they immediately will see in the future that, for instance, Italy will be a case in point. And this is just implying that the rescue fund is too small to serve the needs of Italy, even it defaults only partly. So there's much to do in the future, and this does not seem to be ready.
As far as Greece goes, is it back to square one?
Yeah, Greece is not really back on the tracks. What we guess is that they need to go down to a public debt share to GDP of 90 percentage points. What this package arrives at will be 125 percentage points of public debt as a share of GDP. So it's not enough and not sustainable.
OK, Mr. Belke, don't move a muscle. I've got some more questions for you in a minute.
Yes.
First of all of this uncertainty at the moment here in Europe has got investors pouring their money into safe havens like gold, of course, and the Swiss franc. An increasingly strong Swiss franc is great for the banks, but what about Swiss exporters? Their products have suddenly become more expensive. Our reporter braved her way through all of the market turbulence to get to the eye of the storm, where calm prevails while everything else around it is in a spin.
Sober and discreet. The Swiss business model is working just the way it always has. Questions aren't always asked about the billions investors bring into the country. At Vontobel, a Swiss private bank, Peter Fanconi looks after particularly wealthy customers, such as companies or rich families. Since the euro hit troubled waters, they prefer to buy Swiss francs.
It's clear that first and foremost they want security and protection against further loss of assets. On the other hand, they also hope for a return that's much higher in relation to other investments.
Zurich enjoys an especially positive image in Europe as a financial centre. These days, those with money prefer to buy Swiss francs instead of euros. The result? The Swiss currency is gaining in value and becoming more expensive, a rise of 20% since January. The country's largest bank is UBS. Sandro Marino is a financial analyst. He sees why investors place so much trust in the Swiss currency. One reason is the country's sound budgeting policies.
In 2001, Switzerland introduced an amendment to its constitution, what we call a debt brake. In years when the economy is doing well, the government has to spend less than in the years when it's doing badly. In other words, there's a mechanism that ensures the national debt remains balanced.
But some businesses are having problems.
We could make a series of bottles reflecting the currency crisis. We've already got Greece, Portugal, Spain, Italy here.
Some gallows humor from the boss. The euro crisis is affecting his business. The SIG company makes bottles. 90% of them go to the euro and dollar zones. The strong franc makes the bottles very expensive there, and sales have dropped by 20%. The company has to make cuts and lay off workers.
We market our bottles, all of which are produced in Switzerland, as a Swiss product. Everything, including the plastic, is produced in Switzerland. That's why we can't go into other markets such as the Eurozone or Asia. It's impossible for us to transfer production to other countries.
Peter Fanconi thinks that will remain a problem. He says the latest rescue package for Greece doesn't mean the euro crisis is over. Would the Swiss franc perhaps have been a better currency for the European Union?
I think we should remain as we are. We've done well and would rather attract customers to Switzerland than export our francs to the EU.
Peter Fanconi recommends that Eurozone politicians keep calm and says the large European Union could learn a lot from its little sister, Switzerland.
Well, let's turn our attention now to Ireland, which was the first to hit the wall in this crisis and the first Eurozone member to tap into the bloc's rescue funds. After 3 years of the government slashing and burning, the Irish economy cautiously grew again for the first time in the first quarter of the year. It's come at a high price, however. This week, the country's new Chief Justice said the courts in Dublin have seen a trail of tragedy. Fraught families, separating spouses, lost jobs, homes under siege and companies being wound up. We head now to Dublin to gauge the mood. Most Irish are certainly ready for a turnaround.
Is Ireland back on the road to prosperity? Many people in Dublin followed the Eurozone Emergency Summit in Brussels on television. Their relief is palpable.
I think it was the first time that I watched the news in about 3 years and felt good after watching the news. That's what I thought about that.
Because of what?
Well, I mean, we got a chance to fix what has been done wrong here. Because we got a lower interest rate, we got extra time to pay, we got 15 years instead of 7.5, I think. And so the Irish economy then has a chance to recover.
We've obviously secured a debt cut of €800 million, so I think it's definitely a good thing for Ireland, you know.
The bailout is fantastic for us, 800 million.
Interest payments cut by 800 million a year, according to a report in the Irish Times. That's good news here too, at Jungheinrich, the Irish branch office of the German forklift company. 2 years ago, its turnover fell by 40% and lots of employees were laid off. Now the company seems to have come through the worst.
The business is running very well, but that's because of all the measures that we've taken over the last number of years to reduce our internal costs. So now we're dealing with customers who are very price focused, so we have to meet their requirements. And this is going to be the new reality going forward.
Jungheinrich's main customers are in the pharmaceuticals and food industries. Their products are doing better, so Jungheinrich can sell more forklifts again. Everyone here thinks Ireland is on the way to economic recovery.
The growth industry is in the logistics sector, where the movement of goods in and out of Ireland is becoming greater. And this is where we see the jobs, but also the growth where we see the growth is in our youths and our education system. We've got a very highly educated workforce here, and companies from America and companies from Europe see this as an ideal country to set up in.
Speculation on the property market, the bank crisis, billions of euros in debts. German companies in Ireland were also hard hit by the recession. Holger Erdmann of the German-Irish Chamber of Industry and Commerce knows their problems. Many had to lay off employees, but now they want Erdmann to find them skilled Irish workers who speak German.
The Employers Association expects 1.9% growth in 2011. So it looks as if we can expect moderate growth again. Exporters are doing very well, and that's interesting. And exports to Germany are booming right now. Compared with 2010 and 2009, from the Irish standpoint, that's an improvement of 42%. And that's really astonishing.
That's something to drink to. After hours, German and Irish entrepreneurs gather in O'Donoghue's, a traditional pub. So, is the worst over for Ireland?
The only problem now is, of course, that if the ratings agencies still downgrade our debt to junk status, we won't be able to borrow on the open markets for a long time to come.
The bank's the biggest problem. You can't get any credit or anything, you know, like it's all a knock-on effect, you know. So hopefully the French and German will be able to look after us. They help us like they were in business, you know.
So there's plenty to discuss here in O'Donoghue's, and many a Guinness crosses the bar in the process.
Back to our guest, Ansgar Belke. Dublin's still bogged down in debt. Is it too soon to be optimistic about the Irish economy?
I think you should be quite optimistic with respect to the recovery of the Irish economy. There are huge differences with respect to the other euro area countries, for instance, Greece. Look at the starting point of the crisis. Ireland suffered very much from low interest rates. This looks funny, but this has blown up a huge bubble in real estate, and combined with very weak financial supervision, they started from high growth rates and went back into the recession and were very much hit. Totally different case is Greece. So Ireland very much has recovered with respect to exports, and we are very optimistic with respect to growth rates.
But even though they're totally different, can Athens learn something from Dublin, do you think?
Yes, of course. They should lower their domestic demand. They should go much more for exports on a variety of goods, and this is what it should learn. And another aspect is to go more for, not for foreign debt, but for domestic debt. And this is what Ireland is. There's much less of foreign debt.
Could Athens be holding out its hands for another rescue package in another year from now?
So I think that a new rescue package will have to be tailored after 2 years in 2013, because we then will have the new rescue fund in 2013, which will make it much easier to go for debt restructuring. By now you have to go to Greek court in order to get back your money, and this will be different afterwards. So the new package will be tailored, I guess, at least not earlier than within 2 years, or we will see huge transfer programs.
The ratings agency Moody's said this week that default status in Greece is almost certain, as the Eurozone rescue will only provide limited relief. What do you think?
I cannot quite follow this advice by Moody's, and all the other rating agencies put Greece just 4 steps before default. That is to say, on a much better place. And this is justified because Ireland looks forward to receive some help from the so-called European Financial Stability Fund, the current rescue fund which we have. And this is the most remarkable part of the result of the last summit, that the EFSF has new competencies in helping countries, and among them Ireland, at lower interest rates than before.
Well, just briefly on that, what's the way forward for the Eurozone then?
So I think we cannot prevent a transfer union from coming. By the way, we already have it via the European Central Bank, which has bought Greek bonds, Irish bonds and Portuguese bonds. And if there would have not been such kind of summit, the ECB would have even to go for a quantitative easing like the US did, that is to go for buying all the bonds of all euro area member countries. And this would be at the damage of the reputation of our most important asset, the ECB.
Okay, Mr. Belke, thank you very much for coming in.
Thank you very much.